Hello everyone, hope your trading week is going well. In our last video we talked about finding strong and weak cryptos to trade relative to BTC. This one is going to be slightly more long form. Teaching trading in a way that new traders can follow along with is important after all. So to do that, I need to get you to the right place mentally, so I'm going to teach a few concepts about the crypto market, but more on that in a minute. Here's the good news, after watching this video you'll actually have a way to enter trades, but new traders please understand, the video coming after this one will be about risk management, so if you don't have an exit plan or know how to size your positions etc., maybe wait for that. For now know that you shouldn't risk more than 2% of your account on a single trade, or else it will be hard to manage your drawdown. Now let's get into the concepts. Concept number 1, price. Probably right now you think that price of Bitcoin is just like any other price, as if you could go into your grocery store and pick some Bitcoin off the shelf like you can a can of Coke. But price in financial markets is not like this. It's not that static. Market price is decided on by whatever buyers and sellers are present in the market at that moment. There are people who want to buy Bitcoin and there are people who want to sell Bitcoin. The current price of Bitcoin is just the meeting point between the two groups. The price they are prepared to exchange with the other party for. So understand there is no set price like there is for Coke, so you can't get a good or bad deal on Bitcoin. This type of price in the market is far from static, in fact you probably watch it change all the time. Concept number 2, cheap versus expensive. This is the problem with viewing price the same way everyone else does. There is no such thing as cheap and expensive in financial markets. If Bitcoin is down $5,000 and you buy thinking you're getting a bargain, how do you know the price won't go even lower? I get it, buying the dip is a strong held belief amongst investors, so it might be hard to convince you not to blindly slurp up every dying coin you see, but no, there is a better way. Here's the thing, you've probably noticed that over time the price of a cryptocurrency can drift higher or lower. Why is that? Well, out of those two groups of people, buyers and sellers, the size of one group can increase or decrease. If more buyers enter the market, they will buy up all of the Bitcoin at the current price. The excessive buyers will then have to buy from the sellers who are selling at a higher price. This is what made the price drift up over time. In trading we call this a trend. Slap a 200 exponential moving average onto your chart and you can see even more clearly that in this example we are trending higher. So should you be selling every time you think we are topped out? Or should we be trading with the trend? So stop trying to pick the top or bottom. Picking tops and bottoms is one of the hardest things you can do in trading, and you should avoid it if you want to have a chance of making it in this already difficult job. Instead of the common mantra buy low sell high, which might be the most useless piece of advice given to any trader out there. Instead of finding what's cheap, search out for the expensive and buy high sell higher. Concept number 3, institutional activity. No, when I talk about buyers and sellers I'm talking about institutions and hedge funds. These people have enough buying power to take out all the liquidity meaning the buy/sell orders in the market currently. If they do this, the price of the asset will move in the short term. If they buy, the price of the asset will rise. If they sell, the price of the asset will fall. You might think of this as manipulation, but that is wrong. It's simply just how buying and selling in a financial market works. After all, price, as we discussed, is just a history of what people are prepared to buy and sell something for. So if you buy up all the liquidity, you've bought up all the people selling that asset at its current price, meaning the only people left selling are now selling for higher than the previous price. Similarly, when they sell their position, they will sell to everyone looking to buy at current price, so all that will be left are buyers below the previous price. This isn't manipulation, it's simply the mechanics of a market. Let's say this hedge fund wants 10,000 of X crypto. If they want to buy it at current price, they can't, as only 500 of crypto X is being traded at the current price right now. Also, if they buy that 500, it will also send the price shooting upwards for the reasons we just discussed. So how are they going to get around this problem and get their 10,000 crypto X? They are going to do two things. The first is buy over time, so rather than buying all at once they will buy periodically. The second is to drive up the liquidity. If they can make that liquidity go from 500 to 1000, they can fill more of their bags up. Understanding how they, the smart money, bait the majority, the dumb money, into putting their crypto onto the market, is going to be the key. You need to buy and sell with them and get on their side of the market. Since in this example the institution is buying, the price is already trending upwards, but if they stop then buyers have left the market for now. This tips the buyer/seller balance and price will fall. So when you also own crypto X, and you see price having a small correction, if you get put through enough downside you also might sell. If you put a stop loss on your crypto, where did you probably put it? The same place everyone else did, below the previous high low. Price had an impulse move up, and created a range for you to put your stops in. They then stepped back, price fell back to the last impulsive move up, stopping everyone out before continuing with the trend. They can see where the liquidity in the market lies, and they will frequently bring price back, so you will sell to them and they can make more money. So how do we enter? What is the strategy? Well, knowing what you now know after going through those concepts, it's actually quite simple. Step 1 is to find out where price is trending. You will be biased to and trade in that direction. Step 2 is to drop down to the 5-minute and look for any previous aggressive price action. Mark the previous zone where price aggressively got bought up or sold off and wait for price to pull back to this level. Step 3, turn on Heikin Ashi candles and wait for a flat-bottomed/top reversal candle to appear. This means that price has come to your zone of interest, where liquidity lies and institutions have stepped in to buy, and the price has started to continue in the direction of the trend. Never try to pick the top. Using Heikin Ashi candles like this means that the price has already started to reverse and you're jumping on the bandwagon after, not predicting the top. Bonus: how do we implement our golden edge over the market, relative strength? Simple. You've probably done your pre-market analysis and found all the cryptos with strong daily charts relative to Bitcoin. If price of Bitcoin starts heading down to a zone of liquidity, start looking for cryptos on the 5-minute that are not pulling back with Bitcoin, meaning whilst Bitcoin trends lower, the crypto with relative strength is either flat or rising slowly. Buy it when Bitcoin nears its liquidity zone. If institutions bought at the zone and Bitcoin rises, the shitcoin you bought will stop rising slowly and instead slingshot itself into the sky. If the zone doesn't hold on Bitcoin, you can exit your trade on your shitcoin. Since the shitcoin was strong relative to Bitcoin, you will be able to exit at break even. Congratulations, trader. Thanks for watching. Since this is quite a long video, I'll be in the comments on the video and 4chan answering any questions you might have. To those who understood, enjoy having some big odds stacked in your favor whilst you trade.